Okay, good morning. Welcome, everyone. We are going to get started here. I would ask the panelists to go ahead and unmute themselves here. For a few housekeeping items for everyone else has been muted to eliminate background noise. And these presentations today are meant to be casual. We're going to have some Q&A and questions that are open to both the public and some ourselves. If you have questions throughout, I will remind you, you can go ahead and do that in the chat function of Zoom. Questions are encouraged and welcome throughout. So without further ado, we'll get started. And welcome. Welcome to today's early season risk management webinar. I am your host, Jeff Eizenberg. I'm the managing director of RCM Ag Services. Today, we're joined by two presenters. First, Midwest Bank's Vice President, Rebecca King, and RCM Ag Services' very own Jody Lawrence. Both guests are in a unique position. They are working directly with farmers across our region every day, and they're eager to share their thoughts today on the current markets and several early season risk management strategies. Before we get into their backgrounds, again, just a reminder for those that just joined, people are muted and questions are welcome. So thank you in advance for all of your thoughts. And so I'll go ahead and introduce Rebecca and Jody, and we'll jump in to hear what all they have to share with us today. So Rebecca, welcome. You are the Agriculture Division Executive for First Midwest Bank, a division of Old National Bank, something new that's just transpired. So you'll share some information with us about that. Rebecca's role involves overseeing First Midwest Ag Division's, the entire Ag Division, and comprised essentially of 350 clients or more, served by 7 dedicated ag bankers and their support teams. The recent merger with Old National Bank expands the ag footprint of the bank, adding additional ag lending across Indiana, Wisconsin, and Minnesota. So welcome to the panel, Rebecca.
Thanks so much. I'm happy to be here.
Thanks. Good. And then we have Jody Lawrence. For those of you that don't know Jody, I'll give you a bit of his background. Besides the gray hair, that you can see on the screen, he did begin his career and from Memphis farmers on business and marketing plans, which ultimately led to the founding of Strategic with a well-followed daily newsletter. Jody's commentary on ag markets attracts over 6,000 farmers on a daily basis across 33 states, opening up a massive network of ag specialists across the grain and meat complex. Jody's an expert on assisting clients in structuring agriculture hedging via cash, futures, and option market strategies. In today's session, we'll be reviewing First Midwest Bank's support of the ag industry, the ridiculous market volatility that we've all been seeing, Russia-Ukraine war impact on grain and inflation. It will recap the USDA report from yesterday on the March 31st, planting intentions report. And we'll also review some early season risk management strategies as we head into the thick of the planting season. So to start off, I'd like to turn it over to Rebecca, have her start her presentation and give an overview of First Midwest Bank's. Go ahead. Thank you, Rebecca.
Okay, thank you very much. So First Midwest Bank has been very dedicated to the ag industry for over 100 years. We serve communities. We've historically served communities in Northern Illinois, north of the Springfield area primarily. Our recent merger of equals with Old National Bank is opening up lots of new areas. We have dedicated ag bankers in multiple states. The great thing about our team that I love to tell people is that we're all very rooted in agriculture. Either we're involved in our own farming operations, or our RMs grew up on farms, or have been otherwise employed or involved in the ag industry prior to coming to banking. So our ag roots run very deep, and that's something that helps us to really connect with our clients and really understand the day-to-day of their operations. I outlined here just a few of the standard products and services that we have. I'll point out that we do work with clients to offer them hedging lines of credit. That's one thing that we've worked on over the last few years, and everything is very customizable. So what works for one farm and one operation, may not work for yours, but we're always happy to sit down and go over all the things that your organization, your farm needs so that we can provide the right solutions for you. Jeff, would you maybe move on to the next slide for me?
Sure thing. And yeah,
Okay.
and I think Rebecca, you are in a unique spot, having working with all these different farmers and having the communicating with them on a regular basis. We're going to get a chance to ask you a few questions.
Sure.
As we jump in, as we get onto the next few slides, because the work that you do every day touches more than just the few clients. It's really the entire region. So thank you.
Yes, thank you. So this is something I'm super excited about. Our merger with Old National Bank occurred in February. We have added lenders in areas outside of Illinois where we did not have access to communities and to farm operations before. And so as we're all coming together and becoming one team with an ag vertical in a $45 billion bank, it gives us lots of opportunity to go places and to work with clients that we haven't been able to work with before. It opens up new areas of expertise for us because obviously, our historic footprint in Illinois has been very corn and soybean and some cattle and hog driven clients. But as we move into other areas, we can expand the types of offerings that we can do. And still, our bankers are still rooted in their communities. They're still serving those communities. But our footprint has widened just within the last 30 days. We will be adopting the Old National Bank name in July, and we will be all one organization under the Old National flag. So we're really excited about this opportunity.
That's great. No, congratulations on that. It's exciting.
It is. Thank you. So just a little bit about our consultative approach to ag lending. We really work closely with our clients, and when we meet you for the first time, if you're new to our organization or you've just met one of our RMs, I know how they do their jobs and they all do it the right way. They find out about you, what makes your operation tick, what's unique to your operation versus the person down the road. And in terms of solutions and opportunities that we can provide to assist you in being both, having things go more smoothly for you, making your life more simple. That's gonna differ from person to person. So we really value the relationship we build with our clients. And so one of the ways we came to work with RCM today is because we also value your partners. So, in terms of working with RCM, because some of our clients work with RCM, we were able to make this connection and be able to produce this offering for you today. We want to understand your relationships and we want to work within your network so that we understand the challenges and the successes that you're facing. One thing, Jeff, that you and I talked about this year that's so top of mind are the increased fertilizer costs and how that's affecting farm operations.
Yeah, so I think that's definitely a hot topic. There's no doubt. I mean, 40% of the fertilizer being produced in Russia, not to mention the extra costs that were already there. I'd be real curious as to, what we saw yesterday's USDA report we'll get into with Jody, showing that corn acres are down versus expectation and bean acres up. Are you seeing that the impact for the fertilizer cost, leading to a rotation change, or what are you seeing in terms of those extra costs, and how are farmers fighting this challenge?
So I think I think it varies from location to location. One of the things I wanted to emphasize is that we had clients contact us last year saying we want to lock in our rates. That means we need to prepay for some fertilizer costs now, and we want to make sure we have availability on our lines of credit. Those are things that we did to help them so that they could lock in their costs for this year. And when we know your agronomic partners and who you work with, and we get some sense of how they're assisting you, we can be better prepared to provide that level of financing very quickly and turn it around so that you're able to take advantage of those situations. In terms of crop rotation, I think it's all over the board. Some people are not changing. Some people are definitely pivoting. And obviously, weather is going to have, be a factor in some of that as well as we go into the planting season. I would say that from the perspective of costs, farmers have had these wonderful commodity markets for a while now, and that's definitely boosted their cash reserves. So, they're going to be able to weather those costs a little bit more this year, but still planning for the future is going to be very important as margins shrink.
Yeah, and that was another question I had for you as we got thinking about today's webinar is, with the increased cash reserves and profitability that hopefully many farmers took advantage of with the rising commodity prices, where are you seeing the farmers investing? Back inside more storage, improving their machinery upgrades, acquiring more ground. Where have you seen some of the most impacts?
It's really all of those things. Taking advantage of the additional cash flow to upgrade equipment. Specifically last year, there was a big parts shortage, especially in our area of the country. So upgrading equipment, either to take advantage of warranties or trying to ensure that you don't have those breakdowns and have to wait long times for parts. So that's definitely been happening. We've seen some people building fertilizer storage so that they can be more nimble to take advantage of good prices in the market. And that's a big commitment. But for the size of the operations, that may make sense. Certainly upgrading grain storage. And then, this dovetails right into what Jody's going to be talking about is be able to store your grain so that you can take advantage of the markets when you need to. That's something that has just been an ongoing situation for many, many clients over the last 5 or 6 years. So we've definitely seen that as well. Real estate purchases, yes, certainly where it makes sense. And of course, because I'm a banker, I have to give a plug for sitting on some of your cash and increasing that working capital so that you can be able to be more proactive down the road, and especially if we enter into a season of lower prices or compressed margins.
Yeah, I think that also plays into the mention you discussed the bank's willingness to support the hedge lines of credit as well. Could you just describe it? Is it farmer by farmer? Sometimes it's tied inside the operating loan. Sometimes it's a separate line. But
Right.
At the end of the day, freeing up cash flow for other purposes and locking in their forward price margin is really the name of the game, right?
Absolutely. And each season and each marketing season brings different challenges. There may have been times where we've been talking to clients about putting in a floor so that they have opportunity on the upside, but at least locking in, their expenses and their cost of production. And that's where we feel that the hedging lines can come into play. A lot of operations would prefer to keep those expenses separate. So keep, having 2 different lines of credit so they know what they're spending on hedging versus on general operations. We're happy to do that. If some clients aren't interested in doing that, we can include it all on one. So again, just very customizable based on what the client's looking for. And also we have to take into account the level of hedging that they're doing. Is it very basic or is it very sophisticated?
Right. Yeah. At the end of the day, our view is that we partner with the bank and the farmer. And if everybody comes to the table and has an open dialogue about how we're managing the risk, then it becomes a long-term successful relationship that everybody can build on. So
Absolutely.
we greatly appreciate your support in that along those lines. So thank you.
Oh, absolutely. And we do too. We just want our farmers to be successful. financially and agronomically, grow good crops and make good money. So we're
There we
happy to
go.
participate.
That's it. It's easy.
Exactly.
Great. Well, Rebecca, I really appreciate you hosting here today, co-hosting here today, and update on the bank and the merger. So that's exciting. And your contact information is here on the screen. We'll also be sharing it with everyone who's attended. And if anyone has questions, again, please feel free to go ahead and type your messages. If they're directly for Rebecca, I can ask her, or at the end we can also let Jody and Rebecca go back and forth on a few. So without if there aren't any immediate ones, we'll go ahead and jump over to Jody.
Thanks, Jeff.
Jody, you're up to bat.
All right. Thank you, Jeff. Thank you, Rebecca. Little did we know when we put this presentation together that I've been doing all winter. I thought that 22 would be a wild year, and we came up with this title back in November, and it has gotten even worse than we ever could have expected through all the varieties of things that have happened. The South American drought, obviously the horrible situation in Ukraine, fertilizer prices at record highs, and just everything that's going on has increased a level of volatility that most people in the industry have never seen before, whether you're on the farm and cash head side, the elevator side, or at the Board of Trade. So things have gotten to a point where this volatility is going to be around for a long time, and it will it'll probably get worse before it gets better. So you're just going to have to be ready for it. Jeff, will you advance, please?
Yep. Oh, got to get the disclaimer in there. No, don't let anybody fool you. You still have to play. You can be smart and play the risks.
This is a little bit about RCM Ag Services. We have been building our base of offices, been in the business since 2002. Like Jeff said, I've been in the business since the early 90s, started working with RCM as a clearing partner about 12, 13 years ago. And as we are beginning to build out the ag departments in our other brokerage locations, we've been able to contact more farmers and get more risk management plans out there where although we are, yes, in the risk management business, what we're really in is the education business, because the more that we can explain to you and the better information we can get to you to educate you on the risks and possible best uses of futures and options, put you in a position where you understand the markets, understand and can qualify your risk. And that's really what we're here to do. And whether it's individual producers whose risk these days is not only in the fertilizer market, but if something were to happen and the prices go down sharply, there's downside risk to your profit. The commercials have got massive margin exposure where they have risk once you sell them the grain, that the markets continue to go higher and they meet ever rising margin rates. And everybody, whether you're a buyer or a seller, the volatility in these markets has created exceptional risk for everybody involved. And I found this slide, and I think that I could let it run during the entire presentation. This used to be a normal 1 year span, but it now has become a regular 5-minute market interval where we're on the roller coaster. And just looking at it today, a post report day, which historically should be very calm, you've got a 40-cent range in beans, you've got a 25-cent range in corn, a 40-cent range in wheat. Crude is up or down $2 every time you look up. So the volatility is just so magnified in these situations, as seemingly every news event that's come out over the last the first quarter since January has been bullish to price, creating an absolute limited margin for error. And I want to go back to really where I say where this started. The bull market really began in September of 2020, when the U.S. crop began to get smaller at a time heading into harvest when everybody thought we were going to have record yield. And since then, when you're talking about corn trading between 3.25 and 3.50 to where we have old crop today at 7.30 to 7.50, we clearly have had a lot going on in the last 18 months. But let's go back to the January report that highlights what they call the final report of the 2021 crop. There's never really a final report because the USDA can come in and adjust either mistakes they think they made or new information that hits the market. So the only thing that rarely changes in the reports is what they report as final yield. And the most impressive thing about the 2021 crop was your national corn yield set a record at 177 bushels per acre. So congratulations to you on your part in that. It's really a testament to everybody involved in the cycle, whether it's the farmers and the great stewardship of the land, the new products that are coming out, the knowledge of how to apply those products that you get from your agronomists and your salespeople, that we were able to, with some spotty conditions across the country at various times, come up with a national yield record in corn. And the important thing to notice here is, great job. You literally, for a baseball analogy, you pitched a one-hit complete game shutout. You threw a Greg Maddux at him in 85 pitches for all you Cubs fans, or for all you older Cardinals fans like me, you threw a Bob Gibson at him. But the reality was, with our ending stocks coming in at 1.5 billion bushels, you ran into a number that at the end of 20, when that a year ago report came out, our ending stocks were at 1.552. So you did as good a job as you have ever done historically on growing a corn crop, and stocks went down 12 million bushels. So what does that mean for 2022? Well, we saw what happened yesterday with the lower than expected corn acres coming in at 89.49, but you now have no margin for error. You're going from yesterday's starting pitcher throwing a complete game one-hit shutout to the next pitcher needs to pitch a perfect game. And a perfect game in this scenario with 89.49 million acres is going to take a lot of cooperation from Mother Nature, and it's going to have to produce a 183, 184 type national yield, which would set to jump up 7 bushels an acre over last year's record. Would be there's no historical precedent that it can do it. It can happen. Certainly, after everything we've seen, you can never say never. But to be in a position where that's what we have to expect year after year, that yields need to increase, or at least for the next several years, need to increase 3, 4, 5 bushels a year. We know that there is no margin for error, and especially now, with the U.S. continuing to be the 800-pound gorilla in world corn production, all the pressure is going to be on us and what we're going to be able to do. The Russian invasion of the Ukraine, major disruption for world grain trade, and the biggest part of that is, depending on the year, of exportable supplies into the world market for corn and wheat. Ukraine and Russia jockey back and forth between the second and third position of what they can export. U.S. always being number one in corn. But with that, you are talking about potentially the second and third largest world exporters being taken out of the market, or at least severely handicapped to participate in. And to highlight the Ukraine, that's roughly 1.3 billion bushels of corn. And let me do some quick math here. But if the Ukraine does not export any of that corn, the U.S. would have to plant an additional 7 million acres of corn just to make up for what the Ukraine potentially loses. And as you move through the whole thing, you have 1 billion bushels, give or take, lost in beans out of South America, in between Brazil and Argentina, and taking 1 billion bushels out of the world's supply. If it just fell on the U.S., to make that up would have to plant nearly an additional 20 million acres of beans. So in between the corn loss potentially out of the Ukraine, as their country gets more devastated by the day, and their shipping capacity, because now Russia appears to be targeting their major port of Odessa on a much more frequent basis, you're in a position there just simply isn't enough acreage in the United States to move and to help this out. Even if all the acres in CRP were released, it still would it would help, but it would not solve the entire problem. And the reality on the CRP is those acres are in there for a reason, because they are not the most productive acres. And with the whole thing about the Ukraine, as we move forward, you look at what happened Monday and Tuesday, the possibility of a ceasefire, of more substantial peace talks between Putin and Zelensky. You saw the markets, the grain markets in particular, drop very, very sharply for the first time that there was real optimism that Ukraine may get back to some sort of normalcy. And then, of course, as soon as Russia does what Russia does, and they called all those off, the grain market shot straight back up. And we are going to be in that battle for a long period of time. But the one thing we know about the Ukraine is that their window is very similar to ours, that they are within the next, if a month from now they're still at war and have made very limited planting progress, then the world is going to have to really redefine how high is high to be able to ration what's going on there. And that's just obviously potentially one of the problems, U.S. weather problems being another. So there's so many things going on the grain side of the production, corn in particular, that change every 5 minutes seemingly and are impossible to forecast. And that's where risk management in a lot of this, or at least a solid marketing plan for the facts that becomes such a big deal. Demand, everybody talks about demand and how you're going to ration it. We had hoped that China, once they signed phase 1, and they were well on their way at one point to getting close to their phase 1 agreement. They finished, when it ended at the end of 21, they finished 16 billion behind. And you just, that with absolutely no U.S. repercussions on what China's doing, you end up in a position that where our world demand is going to come from, we are quickly making more enemies than friends of our major trading partners. When you look at what's happened in the crude oil industry with Russia, and you look at what's happening with China, and if China potentially invades Taiwan, which is still on the table and talked about often, since they see the rest of the world's been largely inactive about doing anything about Russia invading the Ukraine, then you could turn over a whole bunch of economic sanctions to China. There's so many things. And the one question I got asked a lot over the winter was, what can pull the rug out from under these prices? And that would be China invading Taiwan, and then the U.S. being forced to lose them, at least in the short term, as a trade partner. But it becomes a big game of musical chairs if that were to happen, because if we didn't sell anything to China, China would have to find alternate sources. So if Brazil and Argentina sold everything to China, all of the people that were buying from Brazil and Argentina would then have to come to the US. So it would be a very complicated and volatile game of musical chairs, but world political events are going to be impacting our markets deep into 2022, if not for years to come. Back to the Mother Nature part, because she has the final word on everything yield wise that we've talked about to this point. You're in a classic world La Nina setup, and what that is a dry western corn belt and a wet eastern corn belt spring. I went to 50 plus meetings all over the country in the heart of the Midwest this year, and their weather patterns were eerily similar to last year. And if that's the case, then we and with snow flying in some of the counties where everybody's tuning in from today, a cool wet spring does nobody any good. And as that progresses, you get to a point that the western corn belt, eastern Nebraska and western Iowa and the Dakotas are even drier than they were at this point last year. And they started out the season in major deficits. So the La Nina pattern is concerning. It can change quickly. Very difficult to have confidence in any long-term weather model, but we are in a position where you should at least for, through planting to Memorial Day, see very similar conditions that you saw last year if the La Nina stays at its current strength. Yesterday's report, a lot of excitement around it, and ultimately the high price of fertilizer and the fact that to grow an acre of corn that you feel like you're going to get maximum fertility program on, whether it's 200 or 250 bushels that you expect to get, the national corn average's input cost is now over $1,000 with multiple places. I saw one yesterday from more in South Central Illinois that they're fully budgeting $1,275 an acre for a fully fertilized corn program. And when you look at that's up, in some cases $400, $500, $600 an acre over last year, you can see that did show up in this year's corn calculations, because at 89.49, that's nearly 4 million less than what we ended up planting last year. Although the March report of 21 did show a lower number than we finished with, the fertilizer logistic issue, availability, and cost are really going to hamper any corn acre expansion. And that's why you got December corn up another 7 today, over 690, traded to 693 3/4, contract high for December 22 corn, and the all-time high for a December corn price on April 1st. So the story is very easy to understand when you talk about high fertilizer, simply because you can look at where December corn is trading, that they're trying to motivate everyone in the US and the Northern Hemisphere, and that would include China, our allies in Europe, Ukraine, if they can get there, everybody to plant as many corn acres as possible, because corn is really the market that has got the most dire outlook if situation in Ukraine doesn't change fairly quickly. The bean numbers makes complete sense. If you're going to lose corn acres, you're going to pick up bean acres. And if you just look at some of the swaps, the three big ones, Iowa, Illinois, Indiana, each lost 300,000 acres of corn, almost 1-to-1 to beans, and Minnesota lost 600,000 acres. So there's 1.2 million acres of corn that people either made an economic decision to plant beans simply because of the lower cover charge to get that acre planted, or just normal rotation pulled some acres across. The wheat acres up from last year, as we knew it would. Wheat did make a new all-time high earlier this year on the Ukraine invasion, got well over 1350, and it has moderated and come back pretty sharply, now trading under $10. But you still have a lot of people who this year went back in the Dakotas and in the Northern Plains to plant more wheat acres, simply because they have struggled the past couple of years with their corn yields. Really no point in talking too much more about your input prices. You know they're high. I encourage everybody, if you do not have it, I've talked to people all over the country, whether they are fertilizer guys or in the business of buying or selling it or importing it, that it's not going to get substantially cheaper. And the logistics of getting what you need, if you do not have it purchased yet, could be a major problem. So I know it's going to hurt to write the checks, but if you're going to plant corn at these levels, I don't think you want to put $1,000 in, need fertilizer to put another couple $100 in to get your maximum yield, and at this high rate only put on a 75% or 80% of your fertility program. But as you buy it, as you write the checks and are sure that it's going to be delivered on farm in a timely manner, make some sales. Just as a reasonable precaution, because the last thing you want to do now that we're up here is buy fertilizer inputs when December corn's at $6.91 and then sell that corn for $6 if by chance acres go up and the price clearly could go a lot lower from a record high where we're sitting. So it's going to take some moderation. It's going to take a lot of patience to get through what we're doing. But the nice part about it is you've got the highest February crop insurance on your revenue-based insurance products that we've ever seen. December corn came in at $5.90, which seems like an awfully long time ago when we're trading $6.91 corn now, with beans at $14.33, which is interesting because November beans now are trading at $14.11. So you already have a floor, a put option on your beans that is working in your favor. You paid a lot more for your insurance this year because the crop on the revenue side, particularly because the prices were so much higher. But since you have that floor, know you have that floor and use it as in your marketing plan. You know that for 85%, if you purchased 85% on the revenue, you have got a floor at $14.33 on your beans, minus whatever your basis is for fall delivery. That's a good feeling to have, and why you were probably glad to write a bigger check for your insurance this year. The December corn one becomes an issue because now that even though that's a record high for the February average crop insurance price at $5.90 for corn, it's now, like we said, $1 below where the market is. So as soon as you know all of your input costs, have everything purchased, put yourself in a position to start making sales. And that is the responsible, logical thing to do. But then as human nature creeps into all marketing plans, in the back of your mind, you're thinking, well, what happens if the Ukraine doesn't plant anything? What happens if corn goes to $8, $9? And I'm not ruling out this year, if Mother Nature doesn't cooperate, that we couldn't see a 10 in front of corn and a 20 in front of beans. So you have got to take some sort of protection as you make these sales, because what you're really buying, you're not buying something to stroke your ego and say, okay, I made a good decision, sold some corn at 690. And then bought calls to add to it. Those calls are protecting the very high likelihood that next year's fertilizer costs are not going to go down, because similar to last year, or in absolute complete contradiction to the 2021 season, where you bought all your inputs when corn was trading between $3.50 and $4 when those prices were set. You sold, or had the opportunity to sell, a majority of your crop well over $5, if not $6 or $7. And your margins in the 2021 crop cycle were as big as as on farm had ever seen. The 22 and 23 margins are going to be significantly tighter. Instead of hundreds and hundreds of dollars an acre, you're going to be profitable because prices are so good, but you are going to be getting less return on your investment. And this year that investment is substantial. The slide that we just moved to, this is what I call the common sense slide, because you can look back and say, okay, the last time prices were this high were the last time corn and beans made their record price levels, right after the 2012 drought, in that August, September, October timeframe of 2012. And what all the fertilizer companies knew before Russia, who exports 40% of the world's fertilizer, and before all the COVID logistics issues, was that if the price of corn moves up or down, we need to move our price to either make more money or keep the ratio the same, to make sure our farmers and our buyers are making money. And a combination of things in between high freight cost, lack of supply because of Russia coming out of the market, any number of other things that you want to go into, all the COVID employment issues and lack of employees have pushed prices right back to where we are. And when you look at projections, and I'm not in the fertilizer projection business, but all the people I talk to certainly do not see these prices going down sharply between now and pre-plant, or in your pre-plant cycle by the end of the year. And to give you an idea, the December 23 corn price is at $6.18, so it's at a 72-cent discount to it's a 72-cent discount to where we are right now. Let's see. Okay. There we go. Let's go to that one. Back to the risk management part of it. Where we're sitting is, like I said earlier, you have to be responsible and realistic and make cash sales, but you also have to look at a couple different factors. What's this year's profit buying? And this year's profit is buying next year's inputs. A lot of the things that Rebecca talked about, but certainly the great unknown of where fertilizer costs could be next year. You're in a position that you have to address the fact, if corn keeps rallying, your input costs are going to go up with it. That slide we showed you a couple ago. So this is the basic, option formula that we've got. We've got other ones that could be more tailor fit to your operation, but if your job is to go out and you want to sell some cash in a bullish rallying market, which is where we are now, and this is the prices are a little bit off because July corn is now a little bit, well, it's right at $7.25, so this is still fairly accurate. Prices, basically where you said is prices have rallied to a point where you want to sell some older new crop bushels, but you want to keep your upside potential in place if the rallies continue. Makes complete sense. Risk management 101, that you're addressing two different things. And where we sit right now, July corn futures at 725 with a 20 cent under basis. I just took one as fair example. Yours could be much higher or much lower than that, but for this example, it'll be 20 under. And so you're making a 705 cash sale. A great cash sale that at any time while you've been farming, you would have gladly taken and never thought twice about doing. But with all the volatility and all the potential problems in the market, you want to protect that upside. And what we look into is basically trying to fix a cost. What's our budget? And my budget is always for buying corn options, try to buy as much time as possible, as close to the money, for about 20 cents per 5,000 bushels. One contract covers 5,000 bushels. So in this example with July futures at 725, we're going to buy the July 740 $8 call spread. The price when we put this out, I picked that because it was right at 20 cents. You're buying the 740 call for 58 cents. You're selling the $8 call for 38. And the reason why we're not doing just a straight 740 call purchase is because when you start investing 58 cents into a very expensive and very volatile market, 58 cents on a 705 trade, takes you all the way down to, what would that be, 647, and that number just becomes much smaller than I want to take right now. I'll take the 20 cent risk to take it to 685, but I'm not going below there. And the nice thing about this is that it gives you all the way till June 24th, and that will give you 80% of what you need to know, because we know it happened last year, seems to happen every year, that by the time you get to late June, especially 4th of July weekend, you have some major market decisions that have already been made for you. What's your pollination forecast look like? How many acres were planted? So many other things that keeps that window open as long as you can see it to get, to take advantage of it. With that, there are some options, some short-dated options that the board brought out 2-3 years ago that have become much more liquid. And if you decided you wanted to trade in that same time frame for a June 24th expiration, we can buy short-dated calls against the December futures so that you're not dealing in old crop while selling new crop, or vice versa. So there is some flexibility that the Board of Trade has realized through the years that farmers need in their risk management plans. The math is very simple. 5,000 bushels at 20 cents. You're putting up $1,000 per contract plus the execution and costs, and which normally run right at an extra penny, so $50 per contract. And then you have to look at it this way: for the 20 cents that I'm putting in, the total I can make is 40 cents, which is the difference in the 740 $8 spread is 60 cents. So the 20 cents from 60 gives you 40. So you have a 2-for-1 risk to reward, and then there are $2,000 a spread. The hope is obviously you make some sales, corn keeps going up, you buy these options. At that point, you're adding some percentage of that 40 cents to each additional sale to help you manage your risk to pay for next year's inputs. And all this is a basic example. We have a lot of other things. Some of you may be using much more sophisticated, but we've got ideas and plans for every level of operation out there. Jeff, you can go to the next slide, please. Okay. This one, I put out a daily newsletter that Jeff mentioned earlier. And this is on the second page of the newsletter. This is where I sit with all my recommendations right now. Until we see some more spring weather and some other things, I've moved all targets to on hold. I've been very happy with what amounts I've got sold of old crop, of 21 crop, but you can see with the asterisk, that means that I did buy upside call protection. And we started that program for those early sales as far back as October, November of 2020. The new crop at 30%, obviously it's a little sold, but after, and you all, that's the whole thing about marketing. If you sell some and it goes up, you wish you'd sold none. And if you sell some and it goes down, you wish you'd sold all of it. And where we are now is we're just trying to ease small amounts out into a very volatile and unpredictable market. But as you can see, for next year, I have no sales yet. I am not really overly motivated to do anything yet, because I think we've got so much still to learn about where next year's crop prices could be, and fertilizer costs are going to be a big part of when I move to decide to start making some 23 sales. So that's pretty much it. Be happy to take any questions anybody has, and either through Jeff or if somebody just wants to ask them directly.
Thank you, Jody. Thanks, Rebecca. Yeah, no, it is a wild market out there. I think you painted a picture that we all kind of wish wasn't the case, but does all things like you mentioned in market, you can't wish you sold the high or whatnot. It's you have to adapt and adjust to the existing market conditions as they come. And the layered approach, a systematic approach that you've taken here over the course. And again, for people that are listening, this is not Jody's first rodeo. He's been obviously very active in these markets and paying attention to the transitions and changes. And as he mentioned, back in 2020 started to think market prices may go higher. At that time, we were talking about COVID or other, and then after, what's the COVID rally going to look like? And we needed to make sure that we were protected. And so I think it's really important to keep in mind that the point you made, that this year's crop is financing next year's purchases, is so important. Even though it's here and now and it seems so far away, we need to be proactive. And so I greatly appreciate those comments. Rebecca, from your perspective, the farmers you're working with, how does a systematic approach like Jody's laid out kind of, how many people are taking that approach from your side, and what are people thinking about in terms of forward pricing today?
I said to you earlier, we have over 300 customers, so we have 300 different marketing approaches, right? I mean, everyone does it differently based on the size of their operation. We work with quite a few larger farmers that are very proactive in their marketing, and they either do it on their own, some of them being very sophisticated and just reading like Jody's newsletters and making those decisions on their own. Others work with firms, but overall, the same message that's coming from me today is coming out of our relationship managers too, is, find your profitability point. Where is that going to be? And make sure that you're doing something about that, right? Don't let this market go past you, and take advantage of the opportunities that you have so that you're well prepared for what's coming down the road, whatever that may be.
Yeah, no, that's great. It's great advice. And I think, Jody, you mentioned the customization. You've worked with all different types of farmers in different regions as well. I think how would you characterize the approach here? It's as lower risk in terms of its conceptually versus selling futures. I mean, oftentimes people will go out and sell the futures at the prices that they want to carry to sell, but in this case, we're actually transferring that risk to the elevator. Could you just maybe describe that briefly?
Well, that's really the problem where we are right now, because as the markets have gotten more volatile and the Board of Trade has raised margins, and as prices go higher, margins go up naturally. But you're in a position that your average farmer, 95% of the farmers that I talk to, do not need to be shorting futures as their hedge. You're simply, in these environments, way too much risk, because you bring in two separate issues. Either your banker, like Rebecca, has got to completely understand your operation and why you are being short futures or long futures, if you're a buyer for whatever reason, and your spouse better be very, very, very supportive, because there can be some massive margin calls that really no operation needs. And that's why the options were adopted in the first place, was to allow an avenue for farmers to be able to do it in a more cost-effective fashion. And the ADMs of the world understand what they're up against in these type situations. They're going to have enormous margin calls, and they've been dealing with them for a while. And that goes back to why they switched, within the last month. They went from May to July simply to get a lower margin rate and less volatility on their daily accounts, that they were short millions and millions of bushels. So the option strategy certainly works. And I use, just to conserve some time, the idea of selling cash and taking the upside. Right now, the way the market is priced, and all options are priced really by only two things: the amount of time that you buy, and the volatility in the markets. And that time is solely judged by what can happen, and in this example, in the next 3.5 months or 2.5 months. And that, as we know from what we've seen just in the last several weeks, there can be an infinite number of things where these markets could go $1 in either directions, and potentially both, inside that 3 months. So buying puts to set a floor on top of your crop insurance, that's why I talk about the crop insurance. You're really doubling up protection you already have, and you're paying much, much more for it than you are by selling cash and buying out of the money call options.
That's a great point about doubling up, and also your point about this strategy. It's really for anyone, right? It's not just the large farmer. Oftentimes, the smaller farmer feels they don't have as many options for themselves other than the cash sales. And I guess, could you just comment on really its flexibility across the spectrum of the farming community?
Well, buying calls, anybody can do it. We can get accounts set up. That's not an issue. It's a 2 or 3 day process. There's still a lot of people in Chicago are having COVID issues because of, as most of you know that are calling from Illinois, your state still has more severe lockdowns than other places. But when you sell the cash, you are transferring that entire margin exposure to the elevator. You have sold it. They'll give you your check when you deliver it in the fall, and you're reinvesting 2 to 3% of what, if we just took a 5,000 bushel in that example, they're going to write you a check for $35,000, and you're going to be able to basically re-own a significant portion of that for potential 40-cent upside for $1,000. So it's less than 3%. So there's really no reason for you to assume risk by not selling anything, because you're already long or short futures simply because you're in the cash production business. So sell cash, whether it's on a HTA and you wait on basis, or it's just a straight cash contract, and re-owning some appropriately priced call option strategies with enough window of time to make them work. It's really the best thing you can do without riding the wild ride that we are in these markets every day, wondering whether they're going to be up 20 or down 20.
It's great. It's great advice. Rebecca, do you have any final thoughts? We're kind of right here at the top of the hour, kind of a slot for 60 minutes. Did you have any final thoughts to share with the group here before we sign off?
Just, thank you everybody for participating. We love what we do. We love to partner with you. We're very, very focused on making sure that our customers have those profit levels. And we're very supportive of some of the strategies that Jody's talked about. So please reach out to me or to any of our lenders if you have any questions. Hope everyone has a very safe planting season.
Thank you very much. Jody, any final thoughts?
Nope, just everybody have a good weekend and be ready, because it's upon us, and it's going to be another crazy year.
That's for sure. Well, thanks to everyone again, and we will send out an email with a link to this video again if you'd like to listen or share it with any of your friends or people in your community. So thank you again from all of us, and enjoy the rest of your weekend. Thank you all.
Thank you.
Thank you.